Yeah, so we'll be trying to uh, we'll have an interesting session that explains about how net zero will help bankers and borrowers and investors, lenders and investors to minimize their climate risk exposure. So just a brief description, we will set up the structure of the call this evening. So I'll give a brief description about CRFC, and then I'll introduce our speaker for today, uh, who is Durgesh Maru. And then we'll have a 2-3 question poll just to understand what is the participation, where are we joining from, what organizations they're representing representing in today's session. And we'll have a 30-40 minute session from Durgesh, followed by a brief question and answer session. So again, just to give a brief to everyone, we are the Climate Risk and Finance Council. We are a non-profit entity registered in North Carolina, USA. We are a network of professional bankers and largely coming from the risk management and the risk departments of those banks. So what used to be a risk that used to be negated or ignored early on, the climate risk part, has now been uh, has now become a systemic risk. And because of this climate risk, we are going to the societies and businesses will be forced to adapt to these risks, to measure and adapt to these risks. So these addressing this climate risk brings forth a multitude of risks and opportunities for the businesses, and trying to make sense of these businesses, trying to make measure these risks, avoid these risks, identify these opportunities, and to profit from these opportunities is something that every business and banking community and the investing community will be faced going forward. So at CRFC, what we aim to do is to provide thought leadership in perceiving climate risk and its impact on financial institutions, to compile and develop resources for climate change mitigation and adaptation, and to develop philosophical foundations and practical tools to implement climate-related financial risk management in financial institutions. So to achieve those ends, we have started this weekend webinar since last March, which has been a fairly popular series amongst the more interested in the investment community and the banking and insurance community. So this week we have Durgesh Maru. We have invited Durgesh Maru to give a brief about his experience working in the net zero, working in the ESG consulting and the net zero space. So to give a brief description, Durgesh is a very young climate leader. He's a 40 under 40 climate leader and a serial impact entrepreneur. He has worked in ESG consulting, solar energy, and big data analytics earlier. His earlier venture in the sustainable space was the Sun Infra Energies, which went on to become India's top 10 solar rooftop companies, which he co-founded, I think, in in the early teens of the century. In the very recent past, he has co-founded a new company, which is the Net Zero Pro, that helps businesses to accelerate their transition to net zero emissions. He has a good mix of technical, business, and entrepreneurial background, and that gives him an edge in the analysis of the ecosystem that he operates in. He has been a visiting scholar at UC Berkeley and holds a bachelor's in computer engineering from Pune University. He also holds a master's in management from ESSEC Business School from Paris. Before we thank and welcome and thank you for joining us this evening, Durgesh.
Great. Thank you. Thank you very much, Siddharth, Sriram, and the team at CRF for inviting me today. Hello, everyone. Excited to talk to you this evening. Evening in India. And yeah. So I'm Durgesh Maru. I'm the co-founder at Sun Infra Energies and Net Zero Pro. As Siddharth has mentioned, I'm really passionate about sustainability. In my first venture, Sun Infra Energies, we installed solar power plants for industrial and commercial consumers. While interacting with a lot of these consumers and closely observing the climate tech space, we came to realize that that solar energy or renewables was just one of the decarbonization levers, and a lot needs to be done to mitigate climate change. And that's where my interest in net zero grew. And a few of us came together from the background of energy, legal, finance, and climate tech to found Net Zero Pro. So today I'm mainly going to talk about the importance of net zero. I'm going to share, my passion about this journey of helping companies, of helping accelerate the transition to net zero. I'm going to quickly share my screen to take you through a very interesting presentation. So hope my screen is visible by now. Yeah.
Yes, it is. But if you will kindly also make it full screen, please.
Great. Does it look any better now?
Yeah. Okay.
Yeah. Great. So net zero pathways, managing risks and opportunities. Well, climate change doesn't just only poses risks, but it also brings to us a lot of opportunities that we are just going to talk about. We are already close to the tipping point. We are already seeing a lot of climate change around us. There have been a lot of climatic disasters. There have been floods. There have been droughts. There have been glaciers melting. We have seen a lot of wildfires across the world, and the world has lost billions of dollars in terms of physical asset damage due to climate change. And it's not just the developing but as well as the developed world which has suffered a lot, irrespective of the fact that climate change has been caused by a lot of these carbon emissions that have come from across the developed world. So the world is suffering, and the climate science is pretty clear that in order to prevent the worst of climate change, we need to limit the global temperature rise to 1.5 degrees Celsius. Now, the turning point in this journey was this IPCC report of 2018, wherein it was established that in order to limit the global temperature rise to that level, we need to reach global net zero by 2050. Now, with this turning point, net zero became overnight a buzzword. I'm just going to quickly mute myself. I can see some noise. Great. So since net zero became a buzzword, a lot of pressure started developing on large corporates and institutional investors to adopt net zero target. And they started pledging to net zero like before or around 2050. Now, what we believe that, we don't just need targets, but we need these targets to be converted into data-driven actions. And that's where we believe that technology can solve climate change. And we firmly believe that in order to reach net zero, an organization first needs to measure the carbon footprint across their operations and value chain. Next, they need to analyze the data and set science-aligned target. And finally, they need to track progress and report to all stakeholders. Now, I would like to present you some facts of why this climate emergency is there. Now, in order to prevent the worst of climate change, we need to limit global warming to 1.5 degrees Celsius that we have already seen. So science says that we have limited carbon budget, as in there are facts and figures that as compared to today, we cannot emit cumulatively more than 400 gigatons of carbon dioxide equivalent into the atmosphere. Now, business as usual, today the carbon emissions are to the level of 36 to 50 gigatons each year. Now, if you imagine that if we operate business as usual, within 11 years, we are going to exceed the climate budget, the carbon budget, and there would be a disaster. So now you can imagine with how much speed we need to reduce the carbon emissions to a level that this carbon budget is extended to a limit that we reach global net zero by 2050. So business as usual can't really be done. Next, the question now coming to business. We asked businesses what are the major challenges that they face in the current market scenario. So here are some of the responses that we got from them. Number one is that businesses, they want purchase cost optimization and increased profitability. Everybody agrees with this. Next, they want sustained business growth in this current world scenario. This is there. During COVID, we saw that there was a lot of supply chain disruption around the world, which led to a lot of volatility when it comes to the commodity costs, as well as imports, exports, and a lot of things. So this presented how vulnerable we are as a world if we are disrupted with the emergency, as was the pandemic. And now the next big threat that we see today is climate change. Another important issue for business is compliance with regulations. As the impacts of climate change are so drastic and so worse that regulations are picking up very fast across the world, there had always been some or the other environmental regulations, but businesses have always taken them for granted. But it's not going to continue like that, as there is going to be more data-driven action, as there is going to be more compliance. Regulations are like, if the business were to exist, they need to comply with these regulations. Then businesses need access to better financing terms and cost of capital. This is a basic need of running any business. The cost for lenders, the very formula of arriving at a cost of capital is the risk analysis of any business. Until now, financial risk was one of those things, but now it is well established that climate risk is a financial risk. And if your business possesses climate risk and is not disclosing data, then you are very much vulnerable when it comes to whether it comes to access to capital or cost of capital at all. Then businesses, they want to stay ahead of future trends. And finally, businesses want to expand to international markets. Now, every country or every region is coming up with its own regulations with around what kind of imports it's going to accept, and what kind of regulations it's going to have around carbon intensive material. So when we got these responses from the businesses, the question comes that in this changing competitive world, is investment into sustainability worth my time and money? Is it? Well, here is what Larry Fink, the CEO of BlackRock, says, that every company and every industry is going to be transformed by this transition to a net zero world. Now the question is, will you lead or be led? So since the disruption, every industry is going to be disrupted. Now it's in our hand whether we be this first mover, we take this transition to a low carbon economy as a risk or as an opportunity. Now here is an irony. People ask, like, at what cost should we do this? Well, here we say that ESG is actually a money maker. We'll discuss a few facts here for substantiating this. Well, as per this report of Infosys, 90% of the companies that implemented ESG initiatives, they've shown positive financial returns coming up. Now, most of these ESG initiatives that these companies have taken up, they have had an ROI within 3 years. Now you can imagine you're doing good to the world, you're doing good to your finances, at the same time you're staying sustainable. I will give you a classic example. Like when I started my journey with solar, there were just so many questions around financial viability of a solar power plant for a business. We clearly established over a period of time, and there is enough proof of concept, that a solar plant pays back for itself in close to 3 to 4 years. And if all other risks and interest costs, opportunity costs were to be factored in, it pays back within 5 to 6 years, whereas the life of a solar plant is warranted for 25 years. So you can imagine that these ESG initiatives have higher return on investment on any other investment or business opportunity out there. Now, let us understand what are these ESG metrics. Well, the three pillars of environment, social, and governance, this cover certain topics, certain metrics, which impact business in a way or which are impacted by the business. So when a business thinks about transitioning to net zero or measuring its ESG baseline, what it first does is that it does the materiality assessment. As in, it analyzes these hundreds of key ESG issues. It shortlists the ESG metrics that are more, applicable to your business. For example, if you're a bank, or if you're a steel company, or if you're a textiles company, the ESG topics or the ESG issues that are applicable or to your business or that impact your business are different. And these matrices are basically shortlisted and you start measuring your baseline along those. So here is what ESG is about. ESG is this set of topics that impact your business, and investors as well as lenders take into account by integrating these metrics into their credit analysis. Now, talking briefly about the environmental impact. So basically, here are certain environmental topics that are typically a business impacts, and which leads to certain impact on the environment and leads to carbon emission and certain biodiversity as well as environmental losses that create an irreparable impact on our planet Earth. For example, as a business, you consume energy, you consume water, you consume resources. You require travels and logistics services. All of this leads to an increased carbon footprint, air pollution, water pollution, whatnot, and which in turn leads to the environmental impact of things like climate change, the impact on biodiversity, deforestation, waste, water scarcity, and whatnot. Next, what is net zero? Well, I'm sure that since a lot of these companies that I'm talking to today have already set net zero target, I did not explain it in that detail, but still we are often asked what is the difference between net zero and carbon neutrality. So I would like to highlight here that for a business, net zero means first eliminating carbon from all of your immediate operations and value chain, reducing it to a level which is bare minimum and which is doable and reachable with the current technology in place. And it's only for the residual emissions that you would go for carbon offsetting or carbon removal. And this is what will lead to the actual transition to a kind of net zero economy wherein we want to limit the global temperature rise and we don't want cumulative carbon accumulation into the atmosphere. Whereas carbon neutrality simply means that even if you're emitting and you're not taking sufficient steps, you still have an option to buy carbon credits or offset your carbon footprint so that you can claim to be carbon neutral, but that is not really contributing to this cause of climate change. So here I'm going to explain to you what are the different scopes of carbon emissions, or what are direct emissions and what are indirect emissions. Well, scope 1, direct emissions basically are the emissions that come directly out of the assets that are controlled or owned by a company. For example, as an organization, you might own a vehicle fleet. You might be running a lot of refrigeration as well as air conditioning equipment, which leads to fugitive emissions. You might be owning real estate and might be using land assets. So all of these emissions coming out of the assets controlled by you or owned by you are the scope 1 or the direct emissions. Scope 2 or the indirect emissions is basically the result of the energy that you purchase. That is the electricity, heating, or natural gas that a company purchases from the utility that leads to scope 2 emissions. Now comes the most complicated part of the net zero journey, which is scope 3, that is the indirect emissions. This basically is the emissions upstream and downstream, from the point, let's say if you're a manufacturing company, from the point of production of your raw material transportation of this raw material until your plant, then and then you shipping out the finished goods to the end consumer, as well as the usage of this product by the end consumer. So downstream, upstream, as well as the usage of the product is covered by the scope 3, which is the indirect emissions. Well, when we talk of net zero, we often say carbon footprint, but it is not just about carbon. There are overall 6 different types of greenhouse gases that have been identified, and it is the reduction or to the net zero of these greenhouse gases that can truly be called as net zero. So these greenhouse gases include carbon dioxide, methane, nitrous oxide, the hydrofluorocarbons, as well as sulfur fluoroxide. Just to give you a quick example, in school we often heard about the depletion of the ozone layer, and we were always told that this is the result of the carbon of the HFCs, which mainly come out of the refrigeration as well as the air conditioning processes. So so these are also some of the gases that make part of the greenhouse gas emissions. Now I will move on to the social aspects of ESG. When we talk of a transition to net zero, it is not just a quick or a hard and fast transition that we require, but we need a just transition, a transition that takes into account the interests of the society, and that is basically that comes out of decisions, good governance, decision-making systems that lead a country, an organization, or a company onto a path of low carbon economy and a just economy. So I will very quickly cover the social and governance aspects. So some of the key social matrices, these include employee well-being, health and safety of your employee, the product safety and quality, the kind of community relations that you have, the human rights that you have. Companies very well know about EHS, safety and EHS is quite known across industries, the environmental health and safety, but that's just a subset of the social pillar of ESG. Now we have to go beyond that, and EHS has just become one subset of the umbrella term of ESG. Now, what is the corporate governance? So here, Mr. Narayan Murthy, the founder of Infosys has led by example. They have been they have been one of those companies that have, that have taken the sustainability agenda very seriously, and that has led them to create Infosys as an institution, as a sustainable institution to last for generations, and where people aspire to work. So as Mr. Murthy says, corporate governance is about enhancing shareholder value in a way that is equal and fair treatment is given to all its investors, stakeholders, customers, vendors, and society. So one of the problem statements why companies want to transition to net zero is due to this external stakeholder requirement, as in the customers are asking for this. There is data that customers are willing to pay more for sustainably produced products. Investors, they have clear net zero targets, and for investors, the indirect emissions mainly come from their lending books. That is from the loans that they have given out to their lending companies. And that's where they want to lower down the carbon emissions, as in they want to align their investments as well to a net zero or a low carbon economy. Now, what are some of the key governance matrices? Here are some of the matrices: the business ethics, the strategic decision making, the risk and compliance to be made, the related party transactions. So all of key governance is a very important aspect. Though I'm not I'm not competent enough to speak on certain things that happened in the Indian market in the last few days when it comes to the stocks of Adani Group falling, or or the Satyam scandal that happened. All of these things are some or the other ways. These are the result of certain governance practices that were either adopted or not adopted by these organizations. So what is the importance of, here quickly, the importance of S&G when it comes to MSME lenders as well as businesses? Number one is that these directly impact the operations and profitability of a company. Because if you have a healthy workforce, if you have a happy workforce, it will lead to more productivity and thus lead to better operational efficiencies and profitability. Next, ESG finance is quite a trend, and there is a lot of sustainability linked finance as well as green bonds and a lot of such sustainable finance that is out there, that is specifically meant for companies with better ESG rating. And finally, bad governance, it leads to damage to the reputation of companies. It also leads to termination of a lot of customer contracts. The investors, they lose confidence. And then not to mention that companies are paying, and in the future will paying a lot of penalties for their poor performance across the ESG matrices. So just to extend it further, ESG helps in value creation. Then there would be a lot of basically, if you do an ESG assessment, it leads to you are in a position to assess. It brings forth to you what are the risks and challenges facing that your business might face and you are not aware of today. It further builds relevance in your supply chains, and finally, but not the least, it makes you future ready. Because after all, as a business, as a lender, the lender really cares that the business it is funding, it should be a sustainable business, it should be a future ready business, it should be a risk free business, and it should be a business that has a clear plan of transitioning to a better ESG, a low carbon and a net zero economy. And so is the need of your lender, which must start taking action in order to stay relevant in this changing world. So as we have clearly learned that that it is not just environment, but overlooking the social and governance, it hurts profit quite a lot. Now, why ESG? Though we have spoken in depth about it, I will further cover it in this slide, where this concept of ESG, it basically hangs on to the balance between people, planet, and profit. Now, why should companies or investors, they integrate ESG into their investing mechanisms? Number one is the risk perspective. As you do your credit analysis, the climate risk is one of the biggest financial risks, and investors must, and most of them are actually taking this risk into their investment decisions. Second, you have fiduciary duty towards your shareholders. So the companies that you invest into must deliver upon their commitments and must deliver upon the value that has been promised. Economic perspective, that's already there. So I think we have already spoken about what is the importance of ESG, and let me reaffirm that that better ESG is basically a company's license to operate in the eyes of governments and civil society. So if it is this license that gives you the leverage and that makes you future ready, and that makes you a legitimate entity to do business in the future. Now, here are certain quick use cases that I would like to present to you. High employee engagement or satisfaction has been seen as a result of better ESG, because the customers were satisfied. There was sales growth seen. Then there is a higher valuation that a company is able to achieve with a better ESG. When it comes to high carbon intensive businesses, like today, if you look at the steel, cement, chemical industries that are not acting fast, they have seen that there has been an increased cost of debt for them. They are facing higher taxes. Now, when it comes to taxes, these are not just the regulatory taxes that you pay domestically, but also today for for example, the European Union has come up with this carbon border tax mechanism, wherein if a high emission industry such as a steel, cement, fertilizer, or a chemical industry wants to export its component to the Europe, they need to disclose their carbon footprint. And if their carbon emission is above certain KPI defined by the European Union, they need to pay carbon border tax. Then there are organizations like the Bloomberg as well as the Sustainalytics that are publishing the ESG ratings. And if you're not acting enough in time, your ESG rating may be downgraded, and that may go bad in the eyes of your potential investors, and your company may lose credibility. Here are certain data-driven. Here is some data I would like to present in terms of the better ESG. This is a result of these results we have drawn from the McKinsey as well as Infosys reports. Number one, a company gets a competitive advantage if it has better ESG rating, as it has better access to resources. It sees business growth. It also leads to supply chain optimization, as in there are a number of things such as energy efficiency, resource efficiency, logistics optimization, strategic freedom that a company gains out of better ESG. Now, 60% companies have reported that executing ESG projects that have helped them reduce the cost and thus increase their operational profits. It has also helped them attract and retain talent as such, because it enhances the employee motivation. It gives them a sense of purpose. It increases transparency, and it has always shown employee satisfaction. Now, I would like to highlight that what is corporate India doing in terms of better ESG, and what different industries are doing in this space. We know that companies like Reliance Industries, which was heavily invested in oil and gas, very rightly saw the opportunity and has invested and has very large ambitions when it comes to the green energy division of the business, because they see as an indispensable part of their growth. If they don't go green now, if they don't catch the theme now, they would be in big trouble. So large companies have already sensed the importance of ESG and are doing a lot about it. If you talk of Godrej Group has already adopted close to 30% renewable energy. They have robust waste management practices. They have net zero water policies already in place. Then there are companies like Asian Paints, Ultratech Cement, HUL, Pidilite Industries, Procter and Gamble that are doing a lot of things in this space, which for the sake of time I would avoid. But I really motivate each one of you to explore, and you'd be surprised to see that large companies have taken a lot of steps, and we must use these examples to motivate MSMEs and smaller and relatively smaller companies in these sectors to become proactive and make themselves future-proof with better adoption of ESG. Well, there has been coming to the regulatory push of ESG. Now, ESG reporting regulations, they are catching up a lot of pace across the world. So here are some of the regulations that I would like to mention. Number one, in India, SEBI has mandated ESG reporting as per BRSR framework for top 1,000 listed companies from this financial year of 2022-23. And it won't take much time until it extends to all listed companies. The European Union has introduced CSRD, and the kind of criteria that they have laid, close to 50,000 companies will be required to report on their carbon footprint and ESG starting from 2024. The SEC in the US, they have mandated climate scope 1 and 2 disclosures for all listed companies, as in there are certain for all the federal purchases, for all the government purchases, all 3 scopes of carbon emission climate disclosures have been made mandated. Now, since we have understood the importance of net zero, the importance of ESG, I would like to quickly talk about our services at Net Zero Pro in brief. And it's not just Net Zero Pro. I encourage you to consult with technology companies that you're more comfortable with, and but get down to your sustainability, get started with your sustainability, or improvise upon your sustainability to stay future proof and relevant in the transitioning economy. So Net Zero Pro, we founded Net Zero Pro as a software and consulting platform that helps these enterprises as well as institutional investors to measure, report, and act on their carbon footprint and ESG performance. As we firmly believe that what gets measured gets managed. We believe that technology can solve climate change, and here we are onto a mission to enable every organization with the technology to factor ESG into their investments, actions, and decisions that they make. Having said that, companies today are actually are taking approaches towards ESG management and reporting, but all of these actions are happening quite in silos. As in, companies do appoint energy auditors and consultants who perform quick fix audits, who give quick fix solutions, and who provide companies with report, a once in a year kind of a report, or a once as a need report that they provide. Companies also work with large strategy and management consultants like the Big Fours, who conduct workshops through the years with analysis and build a one-off strategy. But it is quite an expensive exercise, and it's a one-off thing. And companies, they have started having internal ESG teams who basically collect data from across the organization by conducting surveys or by collecting data manually, and they submit and they do the ESG reporting. So all of this is happening in silos. And don't take me wrong, one of the McKinsey report says that the chief sustainability officer is going to be the highest paid executive onto a company's board in the coming times. So that is the kind of importance that boards and investors are giving to ESG, and that's where companies are strengthening their internal teams. Now here we come. Now here is the Net Zero Pro solution. Here we come as a end-to-end decarbonization and ESG management platform. As in, whatever was happening in silos, now we are stitching it all together in a very easy to use and cost-effective manner using our SaaS-based product, the software as a service platform that we have built. Our platform basically helps with carbon management, as in it helps with automated collection of data from across the operations and value chain. It helps companies measure their carbon footprint, track them, and report them across all the scopes of carbon emissions and for their value chains as well. Then our solution, it also has a recommendation engine which recommends certain decarbonization methods and steps which a company can adopt, set science-aligned targets, plan these initiatives, track them, and take actions on reducing these emissions. Finally, our platform also helps with generating automated reports in line with the investor as well as regulatory requirements, thanks to the different templates, inbuilt templates and frameworks that we have on the platform. So here is our platform of Net Zero Pro, which is a world-class carbon accounting and ESG management platform. Here I would like to take a pause and show you a 1-minute video of the platform. Well, here we go.
Climate change is the biggest problem humanity is facing today. We are close to the tipping point. Climate risk is a financial risk, and decarbonization presents the biggest opportunity of the century. Presenting Net Zero Pro, a breakthrough software platform that helps corporates and investors measure, report, and act on their carbon footprint and ESG performance. Here is a peek into the platform. The executive dashboard gives you full visibility into the E, S, and G performance across the company locations. The software lets you measure and analyze the full scope carbon footprint across operations and value chain. You can benchmark it against your industry peers and ideal net zero trajectory. The data collection process is automated with options to upload files, engage stakeholders, or even link into your existing ERP system. You can set ambitious net zero targets, track and model the progress along the way. Our climate science expertise helps you initiate and track progress on the organization-wide decarbonization initiatives. You can offset emissions that you cannot yet reduce by supporting a wide range of certified carbon offset projects across the world. Generate automated reports with industry-recognized frameworks codified in our platform. One can share these with internal and external stakeholders. Our blockchain-based carbon accounting ledger documents all emission calculations, thus providing a high degree of transparency and trust for third-party assurance and audit.
So here was a peek into the Net Zero Pros platform. I will go back to the continuing with the presentation. Well, here quickly, how does the like we often get asked, like how does typically a ESG product work, and how is this technology good enough to support us in our ESG journey? Well, when it comes to first the data collection process, there is flexibility around connection. First, we can ensure that if you have an existing ERP system, our API can help with connecting with your ERP system and ensuring free flow of data from your ERP directly into our system, thus leading to seamless analysis of this data and reporting. Then the platform also enables bulk upload of spreadsheets, because as we understand, companies today, they store data majorly into the spreadsheet format. And finally, the platform also enables manual data input thanks to the kind of user interface that we have built. Now, in the data processing, basically we help measure the, there is automated measurement of scopes of scope 1, 2, and 3 of the carbon emissions. Then we also help you benchmark the key KPIs that you have identified for your business in comparison to the best performing companies in your own industry. What is the output of this product? You can basically have a real-time dashboard that shows a complete analysis across your E, S, and G. Then one can download the ESG report as per the different framework or the format that they prefer. There is a decarbonization recommendation and strategy that they get as output of this product, which they can, along which they can set targets, track the progress, and mark as completed. And finally, all of this data can be exported so that this exported data can become part of your annual report or your ESG report format that you currently have. Next, what does typically adoption of ESG or a net zero target look like? The very first step that you as an organization or the organization that you're lending money to should do is that they should go for a materiality assessment. As in, you start exploring your world. Basically, you operate in a business scenario wherein you are having suppliers, stakeholders, customers, employees. From everybody's perspective, shortlist those ESG metrics that are more material to your business, that have a direct impact on your business, or the matrix that your business impacts. Now, once these matrices have been shortlisted and your materiality assessment has been done, next you go on to measure your baseline. As in, across these matrices, where do you stand today? And where do your competitors or the best performing industry stand? So you get a clear assessment of where you are in this journey. Next, you get to set science-aligned net zero targets as well as ambitious ESG targets. You can report your performance to all the stakeholders, including your employees, investors, regulators. And finally, you get onto a path of continuous improvement. By adopting a software like ours, you basically are able to, in a very cost-effective as well as a continuous manner, get a real-time view all the time of your company's ESG performance, just as you do of your financial performance. And likewise, you can get on top of your net zero and decarbonization journey with minimal time and time, effort spent in and money spent into it. Now, certain advanced.
I think we should now get into the question and answer session, if you could.
Sure, let's do that. I think I'm done, and just a minute that I will take that
Okay.
if people, as people relate with what might ask, like what are certain key ESG enhancement measures. So I'd like to highlight that a company could start with materiality assessment. They can go on to do energy audit, life cycle assessment, policy, peer benchmarking, waste water treatment, circular processes, all these things that they can do. Well, ESG is the future of doing business. Sustainability is the way to do business. Now, organizations, they have to reorient their business models in a way that ESG and net zero targets are completely integrated within. And this is the only way to maximize stakeholder returns or investor returns for banks, financial community, and countries and the communities at large. So with this, I conclude my presentation. Thank you very much, CRF and Siddharth, for this opportunity. I look forward to the questions.
Thank you so much for that, Durgesh. From the session that you have mentioned, it seems that net zero as well as the ESG pathways are not very different. Net zero is a kind of a subset to the broader ESG movement that is happening across the world right now. So thank you so much for that session. So we have a couple of questions. The first question from Ms. Rishti Gada. She says, "Hi, this is Rishti from Loda & Co. ESG practice. In your opinion, have companies actually integrated ESG strategy into their business?"
That's companies have integrated. I would say that there are close to very few. Let's speak of when it comes to the mandate in India applies to the top 1,000 companies. Of these top 1,000 companies, a survey says that only 150 to 200 of them are well prepared to report ESG. But when it comes to integration of ESG into their business strategy, it doesn't seem that more than 50 to 100 companies in India have actually done that. So it's a big void which needs to be filled with good consultants and good evangelizers of ESG in the market, like what CRF is doing, what Loda & Co is trying to do, and a lot of us are trying to do.
Okay, thanks. So the next question is from Mr. Kannan Rajamani. Kannan sir is part of a larger MNC bank, and he works at, I believe, in the risk department of such a bank. So his question is, I guess the biggest challenge in today's banking world is synchronization of net zero targets to ROTE expectations. So what kind of, if you have had any kind of interactions with banks, what has been your experience with respect to that?
Sure. So when we talk to banks, banks do have certain target. We have realized two things. Number one, sustainable financing is a very big opportunity. For instance, Siddharth, if you remember, we just did a session with HSBC
Yes.
last month, and the representatives from HSBC clearly mentioned that that they have that today, for whatever sustainability linked finance that they're giving in India, that's just 1/4 of what the mandate that they have for the next year. And this mandate will keep increasing in a compounding manner. So that is how much a bank is willing to spend on sustainability linked business models. So I would say that banks have a huge appetite, and rightly so is that. Now, when it comes to what should a bank do in order to balance a profitable portfolio and the net zero target, basically, and a bank has an option either to engage or divest with its or divest for a customer. And the win-win approach is engagement, as in a bank should start engaging with all their customers in a way that their customers start assessing and reporting on their ESG credentials, just as they do on their stock report or on their quarterly financial or on their yearly financials. And this engagement will help further the cause.
So, okay, so the follow-up question to that is, when you say engagement, the question that I have whenever I even see your platform is, how easy or difficult is it to measure carbon emissions for MSMEs, especially in India? And given that, see, most MSMEs, even we have worked in the solar space, we know we always want high-rated financial and highly credit-rated organizations, AAA B or B plus, B, double B. Those kind of agencies, organizations is what we prefer to work with, especially with rooftop systems. When we interact on the field, we realize a lot of these MSMEs do not have that kind of credit rating as well, or in some cases they haven't never done any kind of credit rating. So given such a scenario, how easy or difficult is it to get these kind of carbon emission data and therefore to audit it and to make sure that these carbon emissions, whatever they are saying, can be verified? What is the reliability of the data that you are getting?
Well, Siddharth, I'd like to highlight that MSMEs usually act on what is mandated and what seems immediately profitable to them and what seems as a good opportunity to them. Today, most of the MSMEs that we interact with, they don't understand what ESG is all about. Well, a lot of these MSMEs have been doing things in silos just to fulfill the pollution control department's requirements or just to fulfill some local body regulation that has come in. So it's very difficult to basically this knowledge is not there, but it's not very difficult to convince them, because MSMEs today, they've seen that businesses are very vulnerable. Like during the pandemic, they saw that the supply chains are so vulnerable. Their staff turnover is so vulnerable. So they're open ears. It is about us, the banking community, as in the entire financing community, the industry bodies, the legal companies, the consultancies, and the large industry bodies like the MIDCs. All of these people, they have to ensure that that they evangelize the cause of ESG. They evangelize the cause of staying future ready and becoming staying relevant business, staying relevant into the future, in order to bring the ESG agenda to MSME's attention. Another thing is that we need to showcase and establish clear facts and data to the MSMEs, how profitability of business is linked to how better ESG is linked to profitability. It's only then MSME could be convinced into adopting ESG measures. And I think we have a duty, we have a lot of work to do on that. Now, coming to how easy it is to calculate emissions for an MSME, I would say that this high level carbon emission calculation is fairly simple and can be done in matter of hours, because most of this data is already available with MSMEs. It is just that this data is in different formats. It's in silos. It has all to be brought together. It has all to be brought together in a systematic way, in a centralized way. A system has to be created, which will, what we did for within a few hours the first time around can be made a real time or a much quicker process perpetually after that.
See, so from whatever I understand is there are 3 steps to this. One is the measurement part, second is the reporting, and third is the verification part. So what you're saying right now is the measurement part, which is useful for the MSME personally, right? For the organization itself, it is important to know where it stands and where it needs to go. But as far as the banking community, and I understand the investor community would be concerned, is about the verification part. Is the MSME and the people who are helping in measuring this, are those numbers verifiable? So in that sense, where do you see what is the state of the art, or what is the state of the art of the industry, at least in India today? So there is a measurement, reporting, validity. So what do you see?
So the future I see, Siddharth, is that carbon accounting is is supposed to become or is going to become as rigorous as financial accounting? Well, financial accounting today is a very systemized way, is operated in a very systemized manner, wherein journal entries are maintained for each financial transaction, and likewise audits and assurances are done in a certain framework like IFRS, and then there are certain other standards defined by different countries, different bodies. Similarly, for carbon accounting has to become a very standardized, in order for it to become a standardized process, already steps have been taken, like the gold standard of measurement of carbon footprint is defined by this body called GHG protocol, which is based out of Switzerland. GHG protocol has laid down certain guidelines for how carbon accounting has to be done, and then there is this standard called IS 16064. So these are the standards. But now when it comes to transparency, so a software like ours basically could have a ledger system wherein every transaction and every activity causing carbon emission can be a ledger of the same can be put to record, and a ledger of the same can be prepared so that a verifiable and auditable data can be present, and that can be assured. And likewise, I see the future of carbon accounting to be as rigorous as financial accounting. And here we are trying to be the accelerator of the same process.
Okay. Okay. Thanks for that. If there are any other questions, I will take it. It's almost 63 minutes into the session now. Is there any further questions? Very well. Okay. So I'll proceed with that last segment of the session. So it's a vote of thanks. Thank you so much, Durgesh, for taking the time out and preparing this presentation. As a feedback, I would have preferred that you dwelled a little bit more on your experience with HSBC per se, because that is the anchor that our participants would have appreciated the most, or that would have been the most immediately relatable to them as well. I had the opportunity to attend to that particular session, and it was really eye-opening to realize that the organizations in India as well, the banking community in India as well, are looking at net zero and ESG in a very, very serious fashion, and serious money is being bet on such not only bet, but there is serious money to be made out of this. There are risks and opportunities, so there is definitely a lot of scope for fast-moving companies and for newer sustainability-related companies to tap into that kind of opportunities. So thank you so much for this presentation and for this enlightening question and answer session as well. And thank you so much for the participants to join us late in this on a Saturday evening, and those in the other parts of the world to join us so early in the day as well. So thank you so much. Thank you, Sriram, for the technical support. And we hope to see you all again next weekend in our next other forthcoming webinar on ESG, and especially with risk management for the banking community as well. So thank you so much, and good night to you all. Thank you. Good day.
Thank you. Thank you, everyone.
Yes.